Good day, ladies and gentlemen. Welcome to Cash Maestro. And on today's video, we'll be talking about unlocking the world of Forex, your guide to understanding the basics of trading, right? So before we proceed to the business of today, I am reminded of a quote by the famous American author Mark Twain, who once said, "The secret of getting ahead is getting started." So in today's class, we will be talking about that first step towards getting ahead, and in whatever field it may be it business, education, or personal growth. We are all here to learn, right? To share ideas and to grow as individuals. So I invite you all to sit back, relax, and let us embark on this journey of knowledge, inspiration, and growth. Let us learn together. Let us challenge each other, and let us emerge stronger and wiser than we were before. And you can always engage me with your questions in the comment section below. Thank you for joining me on this adventure, and let's get started to today's business. Forex trading. What is Forex trading? Like you always see on the screen, Forex, this is a term that is often used among traders to describe foreign exchange markets, right? So there is nothing that is not tradable in the whole world. Do you get? Even time is being traded. Whatever you do, there is always a buy and sell. There is always a buy and sell in whatever you do. You get? So in the whole world, the banks, what the banks do with your money, they trade with your money. All those money you keep in the bank. Sometimes people think it's when you deposit in the bank, when you come to withdraw, it's same money that you withdraw. No, it's not. The banks trade with your money. Big firms trade with your money. You get? But there is what they do that you do not know. There is price action, there is technical analysis, there is risk management. All those things, when they put them in places, they make profit, and you still get your money without knowing that, okay, there is a major transaction going on with that particular money that you put in there. So, but all about Forex, most times what we trade is currency pairs, right? We trade currency pairs. That's maybe the US against the Japanese yen, or the pounds against the Japanese yen, or against the US dollars, right? So what are currency pairs? So like you can see over your screen, there are over 100 currency pairs available to trade. However, brokers generally provide the most actively traded currency pairs. Some people might be wondering, what is a broker? A broker, they give you the platform where you can actually trade, and these brokers also have the right to actually remove any currency pair they want. So that's why before you actually work with any broker, you have to look through to know, okay, what are their services, what are their terms and conditions, what are their leverage, what is their spread, before you actually look into any broker. So, and I will be focusing on 8 major currency pairs, which you can see on your screen. You have the gold, which is your XAU USD. You have the GBP USD, which is the United Kingdom against the US dollar. That's for your pound. Then your USD JPY, which is your United States against Japanese yen. And you have the USD CAD, which is the United States against Canadian dollars. Then this is NZD USD, which is your New Zealand dollar against your United States dollar. Euro USD, which is your Eurozone dollar and your United States dollar. USD CHF, and it keeps going, right? So those are your currency pairs. But as a forex trader, I will tell you what you might not have heard somewhere or anywhere else. It is very advisable for you to focus on one currency pair. Okay, focus on one currency pair, deal with that currency pair, analyze that currency pair. You should just have a major and a minor. When I mean a major, you have, just like those that play musical instruments, you have a major, which is the one you know how to play best. then a minor is the one that, okay, maybe when you are somewhere and you feel like this instrument is much available, then you want to be different, you have to play this other one, right? So you have to have a major currency and a minor currency. And for me, my major currency is gold and my minor is GBP USD, which means anytime I come to the market, I only analyze gold. But when I am not seeing my movement, or when gold is not playing in my favor, or when price is not moving towards my direction, I tend to look at the GBP USD. Okay, so that's my minor. But it's only like on rare occasions I might trade GBP USD just maybe like twice in a month, but I will trade gold almost like 10 times a week. Do you understand? So gold is my major, then GBP USD is my minor. So you should also have that at the back of your mind. You should not just analyze any chart you see. Do you understand? And I will advise you, do not skip any part of this video so you do not miss any vital information I'm dropping here. So about the currency pairs, we have the base currency and the variable currency, which is your quote currency. Do you understand? So from what I have on my screen, you may want to sell your GBP for USD, and you might want to do this by clicking your sell. Yes, and one reason for doing this may be because of a pattern that formed. Maybe you already have your tweezers on, maybe you're using the candle, your candle is part of your analysis, you get, or you are looking at a downtrend and now you already have a confirmation, maybe a doji confirmation telling you that, okay, at this place you are supposed to sell. Do you understand? That means the GBP is weak and the USD strength is high. Do you understand? So you buy when the base currency is higher than the quote currency, when the strength of the base currency is higher than the strength of the quote currency, and you sell when the strength of the quote currency is higher than the base currency. So all we are trying to say is when Euro USD is higher in market volume, that when the buyers are higher than the USD, the buyers of USD, the market tends to buy. But when the buyers of USD are higher than the buyers of Euro USD, that means you are going to sell. When for USD, when their own buyers are much than for Euro, the market is going to sell. Why? Because the Euro is the base currency and the USD is the quote currency. I don't know if that's clear enough. The Euro is the base currency and the USD is the quote currency. So put it at the back of your mind. When Euro is higher than USD, the market tends to buy. But when USD is higher than Euro, the market tends to sell. So anytime you see a sell in the market, understand that the quote currency is higher. It's having a higher strength than the base currency. And anytime you see a buy, just know that the base currency is higher than the quote currency. It's that clear. So on the next thing we are going to be talking about is our spread, right? So we'll be talking about spread, and a lot of people actually trade any currency pair, do whatever they want in the market without really understanding what spread is all about. So this spread, this is the difference between a forex broker's sell rate and the buy rate when exchanging or trading the currencies. Do you understand? It is the difference between the sell rate and the buy rate of a particular currency pair when trading. Do you understand? Now you might pause the video, read up on what I've dropped in your front. I will just make illustrations and explain where necessary. Do you understand? So I'll be going to an illustration for this. What we mean by spread. So let's say this broker, let's say this is equity, right? Or let's say this is Xness, or this is OctaFX, and I am on the currency pair of I'm trying to trade Euro USD. That means my spread is going to be the difference between this and this. Do you understand? Because this is the pips. So each movement, this is 1.4081. That's the current price. If this one changes to 2, that's 2 pips. If this 2 changes to 3, that's 3 pips. If this 3 changes to 4, like that, it just keeps going. Do you get? So now I'm having 1.4079, 1.4081. So definitely the difference is going to be in the subtraction of these two numbers. So when you open your currency pair and you are trying to buy and you are trying to sell, when you click on buy, the market is going to buy from this zone. Do you get? And when you say sell, the market is going to sell with this. So you are actually taking the difference between the two of them. So that difference is your spread. So when immediately you initiate the trade is going to start on the negative side. That's the trade will start with a negative of 2 pips. Your trade is going to start with a negative of 2 pips. Now some newbies might be wondering, what is pip? I'm coming to that. So your trade is going to start with a negative of 2 pips before the movement, the direction, when it's going in your bias or when you're in profit. Then you set your break even and wait for your trade to play out till it hits your take profit. So you are actually going to be very, very observant of the spread of the broker you're actually trading with, because some brokers do manipulate the market. All right, that's why you need to use a good broker that has a nice spread and good leverage. Okay, so about your lot size and your risk management, this should be the third thing we are talking about today. We've already explained what forex market is. That's in terms of the currency pairs. That's the first one. And the second one, we've already explained what spread is, which is the second one. And now we're talking about lot sizes and risk management, which is the most vital part of forex trading. Because if you don't know how to manage your lot size, if you don't know how to engage with your risk management, if you don't know how to trade without emotions, you can never be a successful forex trader. So you actually have to put your risk management at the back of your mind anytime you are looking at the charts. Always go into the market with what can I afford to lose, right? Go into the market with what can I afford to lose, and do not overtrade, do not over risk your trades. Always keep something to back up. Always have a backup. That there is always a recovery. Like I tell my students, there is always a recovery. So you cannot just lose one trade, and one trade does not mean a bad day. A bad trade does not tell a bad trader. Do you understand? Because nobody owns the market. So you just have to take things easy. You have to walk through your strategy and see what the market is doing. Trade what you see and not what you know. You use what you know to look at the market, but trade what the market is doing. Follow the market. Do not force the market to do what you are telling it to do. Alright? So about your lot size, it is a term among traders as measurement of money used within trading accounts. Right? So let's say you don't trade. It's not like forex is different from crypto, where when you enter a trade with like $100 and you put a leverage of 20x and you're watching the money grow too. No, forex is different. The way forex works, we calculate our money using pips. We use pips and we use lot size, right? So I am just going to give you a simple hint that is going to do it for you. You don't need to memorize. You don't need to actually struggle or stress over how to calculate your lot size and your risk management. You don't need to struggle about that. Just understand that 0.1 lot size for 0.1 lot size, 1 pip is $1. Do you understand? For 0.1 lot size, 1 pip is $1. So if you can actually do your maths, then 0.001 lot size for 1 pip is $0.01. What am I? $0.1, sorry, which is 1 cent. Do you understand? So what I'm trying to say is, for your 0.01, which is your lowest lot size for major currency pairs, which is your lowest lot size, when you're using 0.01, which means 10 pips is $1. Then 0.1 lot size for 1 pip is $1. Is that clear? I will break it down a little for you guys. So right now, look at this market. Look at, like, I'm taking this trade with a lot size of 0.05. Now remember what I told you. I told you that 0.01 lot size for 10 pips is $1, right? And now this market, I'm going in with $100 against $20, which means I'm actually risking $20 for this trade right now. So my total risk of what I'm risking in this market is $100. Do you understand? So if the market is going to have if the market is going to go 50 pips, that means I'll be losing $20 for 50 pips. So that $20 I'm losing in 5 places is $100. Do you understand? Let's go to another example so you get a clearer view of what I'm saying. I'm risking 10 pips as my SL in this market right now. I'm having 10 pips as my stop loss in this market, and I'm using 0.2 lot size. Recall I told you 0.1 lot size means 1 pip is $1. Do you get? So if 0.1 is $1 for per pip, that means 0.2 is $2 per pip. Do you understand? So if this market is going to move 10 pips, which means 2 times 10, which is 20, so I'm risking $20 for this. So what if I'm using a higher stop loss? I increased my stop loss here, right? Which means I'm having a stop loss of 20 pips SL. That means I'm going to reduce my lot size now. Instead of using 0.2, I'm using 0.1. Now recall, 0.1 pip is $1. For 0.1 lot size, 0.1 lot size per pip is $1, right? So I'm having 20 pips here. I'm using 20 pips SL, right? Which means 1 times 20, because if this per pip is giving me $1, which means $1 times 20, I'm having $20. I'm still risking the same $20. Let's say I still increase my stop loss again, which is still half of this, which is 0.05. And remember, 10 pips is $5 for 0.05, because 10 pips is $1 for 0.01. 0.01 lot size times 10 pips, you are going to have $1. Do you understand? Then 0.05 lot size times 10 pips, you are going to have $5. You can get a pen, a paper, jot this down, go through it again, look over it, watch the video over and over again to actually understand what I'm talking about. So if I'm risking 40 pips for this trade, which means if I'm having $10 it's giving me 5, then that 5 times 4 is 20, right? And see, I hope this does it for you. I hope you understand what I'm doing now. I just use 10 pips lot size here, 20 pips lot size here, 40 pips lot size here, but I controlled my 10 pips stop loss, 20 pips stop loss, 40 pips stop loss, but I controlled my lot size, which means I'm still risking $20 for all this trade. Exactly, I still risked just $20 for all this trade. So that's all for the introduction of forex trading. That's you understanding your spread, your lot size, your currency pairs, and the next thing we'll be going over is our MetaTrader. That's our trading app. We'll be going over how to trade with it, how to use it, how to enter a trade, our buy stop, our sell stop, our buy limits, sell limits, buy stop limits, sell stop limits, and for our instant market execution, right? But that will be coming up in the next video after this, because I will need to use my phone, access my MetaTrader, then show you guys how to actually use your phone for trading. So if you enjoyed the video, you can like the video, subscribe, and drop a comment in the comment section below. And also, if you have any questions, engage me in the comment section below. I can't wait to attend to your questions. Okay, so cheers to profits. And if you want to be joining my live sessions, my live classes where I teach technical analysis and how to take trades, you can actually send me an email, so I'll add you to the group, right? Because I actually have to assess people that I'm adding to the group, so I don't just add anybody to that group. So you have to send me an email, then I'll see if I can add you to the group. So with that said and done, thank you for your time, and I hope you find this video very helpful. See you in the next video.